Good day, everyone. It's Friday the 13th, and the week was fairly uneventful for the stock market. But we did see volatility in commodities as well as currencies. Let's start off with the fundamentals as we usually do and work our way down from there. The Commerce Department said Americans increased their spending modestly in August, roughly 0.2%, half of what economists expected. The report was a mixed bag. Consumers spend on cars, electronics, and furniture, but they didn't buy much else. Last month, several retail chains, if you recall, including Nordstrom's, Macy's, and Walmart, cut their profit forecasts for the year. The government also reported that wholesale prices rose 0.3% last month. Over the past year, prices have only gained 1.4%, a sign that inflation remains modest. That's very important. One thing driving wholesale prices higher was energy, which spiked as the conflict with Syria continues. The U.S. Michigan Consumer Sentiment Index fell to 76.8 in September from 82.1 in August, and trading was light on Wall Street heading into the weekend due to the Jewish holiday of Yom Kippur starting at sundown today. Approximately 2.3 billion shares traded hands on the New York Stock Exchange today versus 7 billion, which is the typical average day. Let's take a look at the broad market. First, the reports that came out were mixed to slightly negative, which supported prices and gave a slight lift to the market. Because as most of you are aware, negative economic data will more likely than not cause the Feds to leave the stimuli in place or slow down the tapering to a very slow level. Since the Feds are artificially supporting higher prices with the bond buying program by keeping bonds low, the stock market took this as a bullish indication. The only sector that's really causing any real concern is the financial sector. It's once again below the 50-day moving average. Although this sector does not lead the market, it has very strong influence on the broad market due to the exposure financial sectors have on interest rates. If interest rates move up, and it's only a matter of time, the first sector to feel the heat will be the financials. So let's see if this trend continues and for how long, because financials are officially moving to a downtrend. Since we're fairly close to the 50-day moving average, things can turn around on Monday. However, if we start trading below the $20 level, there's a good chance that sellers will begin coming in and liquidating the financial sector. Before moving on to other markets, I want to touch base on the NASDAQ and the semiconductor sector. If you recall, the semiconductors were trading substantially below the 50-day moving average and rallied very strongly during the last 2 weeks. This is one of the reasons why we saw so much strength in the NASDAQ index. The semiconductor stocks make up a large percentage of the NASDAQ and have a strong influence on other technical sectors as well. Since semiconductors are part of most technology products except for software, you can only imagine the role they play in the tech sector. I would say that the financial sector to the broad market is equivalent to the tech stocks and how they influence the NASDAQ sector. Right now, we're not seeing divergence in the tech sector, but unlike the NASDAQ, we did not see a new high in this subsector. Also, the RSI is starting to go into the 70 level, which is not terribly high, but it does give us an indication that we may be entering overbought conditions. This taken into account with the fact that we have divergence in the NASDAQ gives me a pause as to the next move in the tech index. The NASDAQ's holding up very well right now, but the market now is waiting for the FOMC, and I think we need to see something really surprising to see new highs in the NASDAQ considering the divergence and lack of a breakout to a new high in the chip sector. Also remember what I said earlier in the week. The NASDAQ is very dependent in the big scheme of things on the broad market. And unless we start seeing buying coming into the S&P, our upside in the NASDAQ will be limited. So if you're thinking of going long stocks, especially tech stocks, please take that into account. The next market I want to look at is the gold market. Most of you know that I'm overall very bearish on the gold market, and that I was estimating that we're going to hit 1300. I promised you that I would continue my analysis, and I think we may be done with the downside after getting down to the 1304 level. Here's what I'm seeing right now. We have an island reversal, a small one, but nonetheless an island reversal to the upside. This usually signals a turnaround, maybe not a massive one, but it does signal that the current swing is probably done. The next indicator we need to examine is the RSI, which is approaching the 30 level. This is not oversold, but it's getting there. And remember, the RSI takes a lot to move, and I think Syria is priced into the market already. If you consider the amount of fear and panic we had about Syria last week compared to this week, it's fairly obvious that most of the selling has already occurred, or at least priced into the market. Further, I'm not seeing anyone really talk about this, but we have a fairly good-sized divergence between the gold market and the RSI indicator, which is a third clue that we have that this market may be taking a pause or retracing to the upside. Remember, you can trade GLD if you prefer to trade ETFs. The correlation is extremely close to the actual gold market. The next market I want to touch on is the British pound and how the momentum is continuing to the upside. There are a few things I want to alert you to. The first thing is we penetrated the Bollinger Bands to the upside twice already. If this occurs after a sustained move, and we did have one here, the market usually tends to slow down and pause. Second, we have the RSI level coming extremely close to the 80 level, which gives me a further indication that the pound may be taking a breather for now. Next, we want to look at the broader picture and notice that every strong move, real sustaining moves, either begin or end with a strong range-bound cycle. The cycle typically lasts twice or three times as long as the momentum, but you can tell that there's a shift in cycles between the range-bound choppy phase and the momentum or trending phase. Right now, looking at the weekly chart, it looks like we're going to enter a choppy phase close to where we're currently at. Maybe not exactly here, but in this area. I don't necessarily think that we'll have a fall from these levels. Nothing is giving me those indications, but I do believe we will begin cycling within the next several days. I will update you, but I wanted to alert you to what I'm seeing in the pound right now. There's a few setups for Monday. The first one is a tail gap to the upside, and the ticker is MPWR. Place a buy stop 15 cents above the high, and if filled, place a sell stop 15 cents below today's low. The next setup is a 4x4 to the upside, and the ticker symbol is GPOR. Also place a buy stop 15 cents above today's high, and if filled, place a sell stop 15 cents below today's low. That's it for today's tutorial, and I will update you Sunday as usual. Have a great weekend, everyone.